Good evening. This is Dr. Raju, working as Associate Professor, Madanapalli Institute of Technology and Science, with having 26 years of teaching and research experience. And now I want to present the topic analysis of financial statements. Analysis of financial statements. Without wasting time, we will directly enter into the topic financial statement analysis. See, the basic objective of learning financial statement analysis, there are two words in it: financial statements and analysis. First, you should know what is financial statements. The financial statements are statement of financial position. It is also called as balance sheet. Comprehensive income statement. It is also called as profit and loss account. And changes of equity. And the funds flow statement. Funds flow statement is an analysis statement. It's not a financial statement. And cash flow statement. So, the financial statements, we can tell that statement of changes of equity, statement showing financial position, profit and loss account, statement of comprehensive income, that is also called as balance sheet, called as statement showing financial position. Based on universal terms, also I am discussing. Based on universal accounting, the balance sheet called as statement showing financial position, and the profit and loss account, statement showing comprehensive income statement, and changes of equity. This is new statement in universal accounting. And the cash flow statement. These are the four statements as far as the financial statements are concerned. And coming to analysis, why we do the analysis? There are only 2-3 specific objectives for analyzing the financial statements. First, analyzing the firm's financial condition and measuring the relationships of the financial statements and items, and giving the financial reporting, which is useful for the decision making process. So the main objective of financial statement analysis is, number one, analyzing the financial situation, the short-term position, the long-term. Why we have to analyze? To give reliable information for the creditors, for the outsiders, and for the public, and for the investors who invest the money with the stock market. So for all these people, the financial statement analysis is very important. Financial statement analysis. That's why we are doing. The main objective of financial statement analysis is reporting to the creditors, investors, public, and even for internal and external users of the financial statements. The financial statement analysis depending on the financial statements. Now we'll see the whole thing in slides. See the slides, you will have some very good idea about the financial statement analysis. Please see the slides. Financial statement analysis. What is financial statement analysis? The financial statement analysis is the process of reviewing, analyzing company's financial statements to make better economic decisions to earn income in future. These statements are balance sheet, statement of cash flow, notes to accounts, and profit and loss account. So the main why we prepare the financial statements, there is one reason to make better economic decisions, and at the same time the second one is for better decision making with the organizations. Now coming to the objectives of financial statement analysis. Clear-cutly there are two objectives. One is supplying the information to the stakeholders and outsiders and to the investors, which is very much useful for making investment decisions and internal decision making. In the organization, the top level executives, they must take the appropriate decisions at the right time. And the financial statement analysis shows the relationships and it gives the measurements of financial statements and even the quality of the financial statements. The main two objectives is financial reporting. Second one is showing the measurements and the quality of the financial statements. These two are combinedly useful for making good decisions. The key areas of financial statement analysis are the structure of the financial statements, the economic characteristics of the industry which the firm operates, and the strategies the firm pursues in differentiation with the competitors. That means the structure, the characteristics, and the third one, the strategies which are followed in differentiating with the competitive firms. And coming to the next slide, the steps. What are the steps involved in financial statement analysis? Identify the industry economic characteristics, identify the company strategies, assess the quality of the firm's financial statements, analyze current profitability and risk, prepare forecasted financial statements, and value of the firm. These are the 6 steps to be followed for making the financial statement analysis. The financial statements are: number 1, statement of financial position, also called as balance sheet; statement of comprehensive income, also called as profit and loss account; statement of changes in equity, SOCIE; and finally the cash flow statement. These are the 4 financial statements in financial accounting to be analyzed. The methods and the tools used in financial analysis are: number 1, the comparative analysis; number 2, the trend analysis; number 3, the common size analysis; number 4, ratio analysis; statement of changes in working capital; and funds flow statement. These are the accounting tools, devices which are very much used in making the financial analysis. Coming to the next slide, we'll discuss the comparative analysis. Comparative analysis means it's a comparison between the financial statements belongs to different years. For example, 2009 to 2010 and 2014 to 15. Like that, we will compare all the financial statements, including the profit and loss account and a balance sheet. How much profit earned in 2009 and how much in 2010, whether it is decreased or increased. That is in comparative analysis. It's a comparative comparison between the items. And coming to the trend, the next tool used is trend ratios. So here we'll calculate the percentage increase of trend. from last year to this year, and the graphs, diagrams, how the graph shows the increase or decrease, or in the form of dots, or in the form of histograms, like that. We'll see the trend percentages. Coming to the next slide, and coming to the common size analysis. Common size analysis means it's a percentage statement. The balance sheet total equalized to 100 by 100, and all the items will calculate in the form of percentages. For example, how much the fixed assets, what is the percentage compared with the total value or total of the balance sheet. Even in the profit and loss account also, will equalize the sales with 100% and how much the percentage expenditures, direct and indirect expenditures in the form of percentages will calculate in common size analysis. And coming to the ratio analysis, the ratios are classified. Ratio means a number expressed in terms of another. Even a layman also, who is not known about having the accounting knowledge also, can express, can know, can see the interpretations based on ratio analysis. The ratios are classified into 5 varieties: the profitability, liquidity, activity, debt and market ratios. It's a powerful tool used. It shows the financial positions, short term, long term, and the turnovers, even the debtors turnover ratio or the capital gearing ratio, like that. Infinite number of ratios we can calculate using the ratio analysis. Coming to the next slide. Last slide, which is used funds flow statement. It is based on changes of working capital statement. We will prepare the changes of working capital, whether the working capital increased or decreased. Based on that, we will prepare the funds flow statement, calculating the sources and applications, how the money got, even the money got from funds from operation, and how the funds lost with the operations. Funds flow statement is prepared. It shows the long-term financial position of the business concern. These are the tools used for financial statement analysis. Thank you.